Welcome to this Killick Explains video on risk and return, and welcome to another poll result which I'm going to use to draw out three key lessons, if you like. Now let's get straight to the poll. In the poll this time I asked which would you rather be offered, and you could choose from one of them. £100 now drew 49.1% of the total votes, and in fact was the winning answer. The alternative was £106 in 1 year's time, and that drew less than 1% of the votes. Next up, £117 in 2 years' time, 2.6%. And then the second placed answer, almost the winner, was £140 in 3 years' time, and that drew 47.4% of the responses. So, some quite divergent answers and two clear favourites, if you like. So what are the lessons that we could draw out from this small poll? Well, first of all, it's built on compounding. So in case anyone was wondering where the answers came from, a lot of you will have deduced that in order to get to £106 in 1 year's time, you need to be offered a 6% annual return, £100 times 1.06. In order to get to £117 in 2 years' time, you need to be offered an 8% return, allowing for rounding. So £100 times 1.08 times that result by 1.08 gives you, allowing for a bit of rounding, just less than £117 in 2 years. And to get to 140, again rounding slightly, you need to be offered around 12%, because £100 times 1.12 times 1.12 times 1.12 gets you to about £140. So actually I was offering you £100 to have the cash handed over now, 6% to wait a year, 8% to wait 2 years, and 12% compound to wait 3 years. And you can see the effect that just 3 years of compounding at 12%, should you be able to achieve that, has on £100. It increases it to 140. So that's worth bearing in mind, the awesome power of compounding. Investing's only free lunch, as it's once or twice been described. Now, aside from this being a mechanical test of your ability to compound, what actual lessons can we draw out? I mean, how would you make the choice? Well, risk and return are connected. So what I was suggesting here was that there is something, for example, called time risk. The longer you lock your money up, the greater the overall return you should expect. And that's true whether you invest in cash, bonds, shares, or anything else. Because apart from anything else, you can't put your money to work elsewhere and earn another return. There's an opportunity cost. So yes, I would expect, all other things being equal, to be offered more for taking time risk. Whether as much more as my poll result suggests is another question, but the principle is sound. Next up, what is risk? I mean, how would you make the judgment that 12% is enough for 3 years or 6 is enough for 1? Well, you could do a simple comparison and say, what can I earn on a bank account? And frankly, all the returns I offered in this poll were substantially more than that, that's for sure. But you'd also look at investment risk. What is it I need to invest in to get these returns? So how much price risk is there, or volatility as it's known? How much liquidity risk? That's the ability to get your money back. And how much bankruptcy risk? So if you invest in certain shares, there is a danger you may not get your money back at all, for example. And actually a 3-year time horizon is pretty short. So you'd need to look under the bonnet fairly carefully. You'd need to think, what do I need this money for? Am I likely to need it back quicker than 3 years? Am I prepared to run any risk? If the answer is, I do need it back in the short term, perhaps you'd be better off staying safe in some sort of rainy day fund or something close to cash. So investment risk is an important factor combined with your goals and investing time horizon. Now the next lesson I wanted to draw out is that there is no right answer. So I'm not going to sit here and say, haha, why didn't you go for the fourth option, for example, because actually risk and return are very much personal to the individual investor. For example, I had a few people saying, Tim, the reason I said £100 now is I think I could actually invest that money somewhere else altogether and beat all of your 3 offers. Better than 6 in 1 year, better than 8 in 2 years, and better than 12 in 3. But I would add a note of caution at the end of this video for those people thinking that. I mean, 12% over 3 years is pretty punchy. And just be careful. Yes, shares have offered, in some cases, if you look at the US market, more than that consistently over the last 5 years. But the past is no guide to the future. I would be very reluctant indeed for people to therefore conclude that 6 over 1 year is shabby, 8 over 2 isn't enough, 12 over 3 they can do better than that somewhere else. Maybe, but there are no free lunches in investing, and therefore always look carefully at the amount of risk you're taking on in order to try to achieve those sorts of returns. No one can promise you 12% over the next 3 years, not anyone I know anyway, so be very careful to look at what risk it is you're being asked to take in the hope of achieving it. Now, there are other lessons we could have drawn out, but there are 3 good ones. For more information on things like compounding and investment risk and so on, please do access our extensive library, Killick.com/learn. And for those people who'd like a copy of one of my guides, a good one would be how to invest in equities, for example. It's fairly straightforward, won't take you long to read. Then please ping me an email, editor@killick.com.